So welcome everybody. I'm here with Steve Blumenthal, who is the CEO and the Chief Investment Officer of CMG. And Steve and I have had many conversations over the years about high yield. And Steve has an excellent program with high yield. So Steve, one of the things that's really caught our eye has been your conversation that you think high yield rates could go as high as 12%, much higher than they are right now. Can you just give us some thoughts on the high yield market, where it is and where you think it might go?
Well, thank you. And it's nice to be with you. I'll give you some footing on the history. So I've been trading the intermediate term trends in the high yield bond market since 1990. We've done it a long period of time. High yield trends in a very predictable way. When it's going up, you want to participate. And when it's going down, you want to risk manage. So that's how we've run the strategy for, believe it or not, 30 years now, and hard for me to believe. We have lived through, traded through three significant opportunities. They were material correction. One was in the very early innings of my high yield trading career, and that was with Drexel Burnham and Michael Milken. The recession around '91 and all the drama that in those challenges that got Michael Milken and Drexel Burnham in trouble. That sell-off in the high yield market happened both because of recession and because of fear that there would no longer be this new market that Drexel Burnham and Milken had invented. Of course, that turned out to be a fantastic buying opportunity post-recession, and life went on. In 2000, 2002, same sort of crisis. When you have recession, the troubled debtors get in trouble. They default, prices sell off significantly, and systems clear, and then an opportunity presents. When we went into the 2008-09 environment, and I can tell you in all three periods, I was scared when we got our buy signals on the other side where the opportunity was, and to me that was a gut moment, and it took a steady hand. And as a trader, you learn to see that as opportunity and not. So when we went into 08-09, we knew things were going to be bad. We were writing about what we thought was going to be a 400 billion subprime problem. It turned out to be multiple trillions. And nearly took down the financial system and certainly took out Lehman and Bear. Well, right. Those recessions create phenomenal opportunity. Yields went to 22%. The reason I'm bringing up these three is that I believe because the amount of debt in the system, which we can talk about, and the quality of debt has never been worse, right. That the next recession will create an even greater buying opportunity for high yield. So I think the yields are going to be north of 20%. In the coming opportunity. And of course, I don't know. Much depends on policy response and depth of bailouts.
Yeah. So from where we sit, we are in a recession right now. It looks like Q1 will be down slightly and Q2 will be down dramatically. The guesses about Q3 and Q4 really relate to what happens to the virus. So if we're in a recession right now, you see in the coming months that these opportunities in high yield may present themselves.
Yes, so in the last two recessions, high yield sold off somewhere between 40–50%. When prices drop, yields go up significantly. Of course, certain dropping because you've got fear and exit, investors panicking, you're getting out, but you also have defaults in those default waves. In this next wave, we think the default wave is going to be well north of 50%. So with the quality is difficult. You're not getting recovery that you're going to get, and that's going to be a phenomenal reset opportunity. So if the last two recessions saw prices in the high yield market decline by, call it 50%, this next one, let's call it in the 40–60% range. We think that that's possible.
And how does triple B play into this? 20 years ago, triple B was 20% of the ag. Now it's 50% of the ag. And one of the things that we worry about is the amount of triple B, and can it even be absorbed in the high yield market?
I don't think it can. It's going to have to, but I don't think that that's something that's probable to happen. So what happens? You've got a $5.2 trillion investment grade market. That's how big that is. Half of it is in the triple B space. Of the half that is in, so that says 2.6 trillion is in triple B. It got there because the liquidity within the system was made available because rates drove to zero. Investors sought high returns. They didn't know where to go. They put, and all this money chases into it, and it's enabled a lot of really bad behavior. So borrowers could borrow at terms that were really favorable to them. Private equity shops could cash out, all these sorts. So if we have a $1 trillion high yield junk bond market, that's the size around it. And we have half of the triple B space jumps into the high yield market. You have forced selling by insurance companies and pensions that are required to buy investment grade or better. So the real big problem is in that triple B space. There's a lot of problems, of course, in the high yield space. So it's imagine that high yield market doubling overnight.
Right. And so one of the things that interests us in the way you manage these portfolios is that you have stop losses. And so when I first mentioned 12%, 12% is kind of a number that we have in our mind where we're just interested. If you can get 12% cash flow and you kind of meander through the storm at the end of it, you got 12%. But you use stop losses to make sure as the rates go from 12% to 15% that we don't participate in that whole decline. And if they actually do go to 20%, if you entered at 12%, you'd have huge losses. So can you talk about that a little bit?
Yeah, so I'm fairly transparent with how we do what we do. And the reason I've grown over the years to be transparent about this is, number one, I think stop loss risk management is really important. And as Paul Tudor Jones once said to his, or many students that he was teaching in an MBA program, put a 200-day stop loss moving average on anything you own. You really want, the idea with stop loss risk management is to protect against the really big mistakes. None of us know exactly the timing of anything. But stop losses can give us a pretty good disciplined way of doing things. The way that we trade high yield is the way that we've doing it mostly for the last 30 years. We look at moving averages. We look at relatively short to intermediate term moving averages. I used to tease with the kids is, here's kind of the family secret recipe. And the reality is it's pretty easy to, people are familiar with trend following, 200-day moving averages, 50-day moving averages. Somebody would do a pretty good job if they put a simple 50-day moving average on the price line of the high yield market. So you want to follow just the price index because that's what we're measuring. High yields pay a decent yield. So when they pay their yield, a lot of funds and ETFs go ex-dividend. You want to smooth that out of the equation. But we have a very tight stop. It's not a 50-day moving average. Frankly, it's a little bit tighter than that. And we have rules around it. And our rules deal with how much the price has accelerated. So the bigger risks are when the price acceleration is really quick to the downside. And so when that occurs, we use a little bit of a shorter term moving average. And when high yields moving predictably and not aggressively, we give it more room to breathe. So we toggle up and down a little bit, but the truth is somebody could do a pretty good job with putting, I'm not recommending it because the trick is to be able to have a discipline to be able to follow the rules. That's the hardest part. The easy part is putting the rules in place. And
and the following the rules, as you mentioned, when you get a buy signal, you got buy signals twice in this century that were terrifying to you. And the next one is likely to be as terrifying. We don't know how this financial crisis is going to be impacted by the health crisis that we're in, but we know it's going to be. And when we start to get to the dislocation in the high yield market, we think what you're doing is really, really interesting.
Well, thanks for that. You made a comment the other day when we were talking about the purpose and need for an advisor is to help walk you through the minefield. And a lot of times there aren't any traps to step on.
Right.
But at times of significant dislocation, and they always happen in recession,
Right.
when the lending liquidity drives up, people can't refinance, and that's where the trouble. A third of the companies in the Russell 2000 index, a third of the companies are operating with borrowed money to cover their interest payments. They're
Right.
not making the money to be able to do it. So
Right.
we have, we don't know what policy response will be. We
Right.
do know that it's been bigger than we expected, and that's good. But to think that that's going to paper over all the problems that exist, Warren Buffett said, when the tide goes out, you see who's swimming
Right.
naked. And
Yeah.
I think that day is coming.
Yeah, yeah, I think that's right. And so we're not ready to jump in right now, but we appreciate you spending some time with us, because this is, we think, going to be a critical asset class as we think about the future. So, Steve,
Yeah.
thanks very much.
I keep telling everybody it's going to be the best I've seen in my 30
Yeah.
years of trading. The fourth one's going to be epic.
Yeah.
I'm excited for it, and I'll be as scared when we get to the other side of it, where the opportunity is best.
Good. Okay, Steve, thanks very much.
Thank you, Kevin.